Hey everyone, welcome back. Today we're diving into something I know a lot of you find fascinating and honestly a bit intimidating too. Trying to figure out what a young company is really worth. You know, those startups, big ambitions, but maybe not turning a profit yet.
Yeah, you're talking about companies with negative earnings,
Yeah.
limited track record, and good luck finding a comparable company to even get started.
Exactly. It's a head scratcher, even for seasoned investors. So we're turning to a true valuation expert for this one, Aswath Damodaran. His paper is called The Dark Side of Valuation. And get this, he uses Amazon.com back in 1998 as a case study.
I love that he chose Amazon. Thinking back then, it was just an online bookstore, right? It really gives you perspective on how tough these calls can be.
Right, before they were the everything store. So before we get into the nitty-gritty of Amazon, let's just ground ourselves. What are those core principles that determine a company's value? Those things that always apply.
Always comes back to future cash flows. It's not just about profit today, it's about how much money the company can generate over its lifetime.
And how long will that lifetime be? Some of these startups, it's an open question if they'll even survive, right?
For sure. And then you've got how fast those cash flows will grow and how risky they are. Lots of moving parts.
Which is where our favorite discounted cash flow analysis comes in, or DCF. Trying to predict those future cash flows and then discounting them back to today, because a dollar earned 10 years from now probably isn't worth a dollar today, right?
Absolutely. You got to factor in the time value of money
Yeah.
and the risk. A super risky company, that dollar 10 years out might only be worth a few pennies today.
Makes sense. And this, I think, is where things get extra hairy with young, unprofitable companies. It's like DCF on hard mode.
Yeah, I'd say so. It's like trying to navigate a maze in the dark.
Okay, well, let's turn on a few lights at least, so our listeners can understand where these roadblocks are coming from. First one, and it's a biggie, negative earnings.
It really throws a wrench into the usual growth calculations.
Yeah.
And taxes get super complicated when you're dealing with losses that can be carried forward.
Right. Plus, there's the fundamental question of whether the company will ever turn a profit. Survival is top of mind at that stage.
Absolutely. It's as much about survival as it is about growth.
Okay, roadblock number two. No history to go on. These companies are so new, they barely have any financial data to analyze.
It's like trying to predict where a rocket is going after only seeing the first couple seconds of its launch.
That's a perfect analogy. No trends to spot, hard to estimate risk, and who knows if their projections are even realistic.
You said it. Lots of potential, but potential needs to be proven. And then, of course, there's the no comparables problem.
This one always feels tricky to me. With established companies, you can at least benchmark them against similar businesses.
Right. Get some sense of relative value. But with a truly new, innovative startup, they might be carving out their own path. No easy comparisons.
So we've got these three major roadblocks: negative earnings, no history, and no comparables. Feels daunting already, even before we look at specific numbers.
It is. But that doesn't mean we give up on valuation altogether. It means we need to get more creative, adapt our tools.
Resourceful. I like it. Now let's talk about Damodaran's Amazon case. 1998. Remember dial-up internet. That's the era we're talking about.
Amazon was this young company, huge revenue growth, but still losing money. And comparing them to other internet companies was tough too. That whole sector was wild back then.
So where do you even start with valuing a company like that? What were some of the big decisions Damodaran made?
Well, he realized that things were changing so fast at Amazon, using just the last fiscal year's numbers wasn't going to cut it.
Makes sense. A year in tech can feel like a decade, especially back then, so he did something different.
Use trailing 12-month data instead. More dynamic picture of what was actually going on at the company.
Smart move. And I'm guessing he had to figure out how to deal with those negative earnings too.
Absolutely. Huge challenge was projecting their future revenue growth. Remember, this is before Amazon became the behemoth it is today. Balancing optimism with reality.
Couldn't just assume they'd keep growing at 100% per year forever. Had to think about that slowdown, right?
Exactly. And when it came to profitability, they had to make some tough calls about how their business model would evolve. Projected that Amazon's margins would eventually reach, get this, those of traditional booksellers, like Barnes& Noble.
Wait, so they figured Amazon wouldn't be more profitable than brick-and-mortar stores? But being online, wouldn't they have lower costs?
You'd think so, right? But that's the assumption they made. They figured Amazon's low prices, their focus on growth, would keep margins kind of thin. Plus, traditional retailers would catch up online eventually. More competition.
Interesting. So it wasn't just predicting how much Amazon would sell, but also how the whole industry would shake out. Did they take into account all the money Amazon was pouring into tech and development?
Oh, absolutely.
Yeah.
Amazon's reinvestment needs were unique. They were expensing a lot of those tech costs instead of capitalizing them, so it hit their earnings directly.
Even though they were building valuable stuff for the future, it made their current profits look worse. Tricky. Okay, last piece. Risk. How do you even measure the risk of an internet company back then? The whole internet was kind of risky.
Tough call. They decided to benchmark Amazon's risk against other internet companies, which tended to have high betas, high volatility. Figured Amazon's fate was tied to the overall internet boom, which was still unfolding.
So they weren't just looking at Amazon in a vacuum, but at the whole ecosystem. And I bet, like with most young companies, that terminal value plays a huge role in the valuation.
Spot on. That terminal value, what the company's worth beyond your forecast period, it often makes up the bulk of the total value for these young, high-growth companies. You're valuing what they could become.
A lot riding on those long-term assumptions then. So what does all this mean for our listeners, those trying to wrap their heads around valuing these kinds of companies themselves?
It highlights how important it is to really understand the company, its business model, its competitive advantages. Think about the long game. Be comfortable with some uncertainty.
Sounds like patience is key, not just looking at the next quarter's earnings report.
You got it. It's a long game. And it's not for the faint of heart.
All right, so last time we ended on this idea that relative valuation, looking at how other companies are priced, it can be useful but also a bit dangerous, especially if everyone's getting a little too enthusiastic.
Right. Can't just blindly follow the crowd. So let's circle back to those fundamentals we were talking about. We spent a good chunk of time on the challenges of valuing young companies, especially when they're still losing money.
Yeah, those negative earnings. Seems like that's a common theme with startups. So what are some practical ways to handle that when you're trying to put a price tag on the company?
Dama Darren actually lays out three main approaches in the paper, in which when you choose, it depends on why those earnings are negative in the first place, not a one-size-fits-all situation.
Okay, so diagnose the problem before prescribing the solution. Makes sense. What's the first approach then?
It's called normalizing earnings. Works best when those negative earnings are just a temporary thing, like maybe the company went through a rough patch, a recession, or something unusual happened, but you expect them to bounce back.
So it's kind of like saying, okay, this year was a bit of a wash. Let's pretend it was a normal year and use that as our starting point. Any real world examples of how that might work?
Dama Darren uses Ford Motor Company back in 1992. Economy was coming out of a recession, and Ford was actually reporting negative earnings per share. So to value them, they normalized those earnings. Looked at Ford's average return on equity over a few years, applied it to their current book value, and boom, they had a positive earnings figure to work with.
So they kind of smoothed out the bumps in the road. Makes sense for a company like Ford, they're affected by the economic cycle. But what about companies whose negative earnings aren't just a temporary blip, more like they're struggling to figure things out?
That's where the second approach comes in. Revenue and margin projections. Instead of fixating on earnings, which are negative, you shift your focus to revenues, which should always be positive, right? You project how those revenues will grow, and importantly, how the company's profit margins will improve as they mature.
So basically we're saying, okay, they're losing money now, but as they grow, get more efficient, those margins should get better. Eventually they'll be profitable. Does Dama Darren give an example of this one in action?
He does. He uses Boston Chicken. Late 1990s, they were having some cost control problems. So to value them, they projected that Boston Chicken's margins would gradually improve, eventually get close to the average for fast food restaurants.
Using the industry as a guide then, what a healthy margin should look like for them. But this approach hinges on getting those revenue growth projections right and the margin improvement. Sounds tricky.
For sure, a lot of factors at play. The company's specific situation, what their competition is doing, the overall economy. You're making some educated guesses about the future. Got to make sure those guesses are based on solid research.
More than just plugging numbers into a spreadsheet. You got to understand the business, the big picture. Okay, so we've got normalizing earnings, we've got projecting revenues and margins. What's the third way to handle those negative earnings?
This one's especially relevant when a company's losing money just because they have too much debt, not because their core business is bad.
So the problem isn't what they're selling, is how they're financed. Too much debt weighing them down.
Exactly. So you adjust their leverage, figure out how much debt they can realistically handle, given their cash flow, and then adjust their earnings based on that.
Like a financial makeover on paper. Let's pretend they had a reasonable amount of debt and see what their earnings would look like.
That's a good way to think about it. And as they grow, hopefully pay down that debt, those earnings should start looking much better.
Okay, three approaches. Normalize, project, adjust. How do you know which one to use when you're staring at those red numbers on the income statement?
Ask yourself, why are those earnings negative? Is it temporary? Is it their operations? Or is it just too much debt? The answer should guide you toward the right method.
So diagnosis first, treatment second. Now, what about those other two challenges we talked about? The lack of historical data and the lack of comparable companies. How do you deal with those when trying to value these young businesses?
Here's the cool part. They can actually help each other out. If you've got a company with a short history, but you can find a bunch of good comparable companies, you can use their data to fill in some of the gaps.
Like borrowing a cup of sugar from your neighbor when you're baking a cake. Got to use what you've got.
Exactly. And the opposite is true too. Longer track record for the company. Even if there aren't many direct comparisons, that historical data is super valuable, helps you make better projections.
So history and comparables, they can work together. But what if you've got the trifecta? Negative earnings, limited history, and no good comparables. That sounds like a valuation nightmare.
Definitely adds to the complexity, yeah. But it's not impossible. The key is to go back to those fundamental principles of valuation and get even more creative. We're talking now being resourceful, being adaptable in our approach.
All right, let's get practical then. What are some things our listener can do when they're faced with this kind of puzzle?
First thing, make sure you're using the most current financial data. Things change fast with these young companies. Even year-old data can be outdated. Find the latest info, even if it's just quarterly numbers.
So don't just rely on those annual reports. Go digging for more recent updates. Got it.
Right, the fresher, the better. Now, once you have a handle on where they stand today, you got to think about the future. Estimating their revenue growth, that's a big one.
Okay, how do you even begin to predict the future revenue of a company that's barely out of the starting blocks?
Well, you can look at their past revenue growth, but don't just blindly extrapolate that into the future. Think about their market. Is it a fast-growing market? Or is it more mature, slower growth?
Right, like a rising tide lifts all boats. But even in a growing market, some companies will do better than others. How do you identify those potential winners?
That's where competitive advantages come in. Do they have a unique product? Strong brand? Are they a first mover in a market that's hard to break into? Those are the things that can drive sustainable growth.
So we're not just looking at numbers here, but also those qualitative factors, what Warren Buffett calls the moat. Okay, let's say you have a sense of their revenue growth potential. What's the next piece of the puzzle?
Now you got to estimate their sustainable profit margin. What kind of margin will they achieve once they're more mature? This is where it gets really tricky, especially if you don't have good, comparable companies to guide you.
Yeah, it feels like we're trying to predict the future. How do you even approach that?
You got to really understand their business model and how the competitive landscape will probably evolve.
Yeah.
What will the industry look like in 5, 10 years? Will the company be able to keep prices high enough? Will new competition squeeze their margins?
So many moving parts. It's like playing chess, but you're trying to think several moves ahead.
Exactly. Balance your optimism about the company's potential with a healthy dose of realism. Okay, so you've got a sense of their revenue growth, their potential margins. Now what?
Reinvestment needs, right. How much money will they need to keep plowing back into the business to keep growing?
Exactly. And those needs, they'll depend on their business model, their growth strategy. Some industries just require more capital than others.
Right, like a software company can grow really fast without tons of physical assets, but a manufacturing company, they might need to build new factories to expand.
Exactly. And once you've estimated those reinvestment needs, you can start projecting their future cash flows, even if those cash flows start out negative.
Okay, starting to see how the pieces fit together, but we haven't talked about risk yet. How do you factor in the riskiness of those future cash flows? It feels like we're dealing with a lot of assumptions here.
That's where the cost of capital comes in. It's the rate of return that investors require to compensate them for the risk of investing in the company. And this is where the lack of historical data and comparable companies can really make things tough.
Yeah, how do you quantify risk when you don't have a lot to go on?
Not easy.
Mm-hmm.
But you can look at their financials. How volatile have their earnings been? How much debt do they have? You can also think about the risk of the overall industry and where this company sits within that industry.
So more of a qualitative assessment, then, still grounded in financial principles.
Right. Trying to capture the essence of the risk, even if you don't have perfect numbers. Okay, so we've estimated their revenue growth, their margins, their reinvestment needs, and we've thought about the cost of capital. Can we finally value the company?
Drum roll, please.
We're getting there. Now you can build a discounted cash flow model, just like you would with a more mature company. Project those cash flows, discount them back to today, add it all up, and you have a total value.
And don't forget that terminal value.
Of course. The terminal value, it's especially important with these young companies because so much of their value is way out in the future.
Like valuing a tiny sapling based on what kind of massive oak tree it might become. Big potential, but no guarantee.
Love that analogy. It highlights why it's so important to be realistic with those assumptions. Now, once you have that total value, you divide it by the number of shares to get a per share value. But with young companies, you need to be careful about dilution. Lots of stock options out there.
Right. Those options represent potential future shares, which could dilute the ownership of the existing shareholders. Got to factor that in.
Exactly. So you subtract the value of those options from the total company value before you divide by the number of shares.
All right, we've covered a lot of ground here. Valuing young companies, it's definitely complex, but it's not impossible. What are some key things our listeners should remember if they're thinking about investing in these types of companies?
What should they be laser focused on? Focus on the long-term sustainability of the business. Don't get distracted by those short-term earnings swings. Look for companies with strong competitive advantages, good management teams, a clear path to profitability.
And diversification, that's always a good idea, right?
Yeah.
Especially with these riskier investments.
Absolutely. Don't put all your eggs in one basket. Spread your bets across multiple companies, multiple industries, and be prepared to be wrong sometimes. Even the best investors get it wrong.
Good advice. Now, before we wrap up this part, let's talk about relative valuation. It's tempting to look at how similar companies are priced and use that as a shortcut. Why bother with all this DCF modeling when you can just peek at your neighbor's valuation?
It can be tempting, but also a trap. Remember, relative valuation only works if the market is valuing those other companies correctly.
If everyone else is wrong, you're just following them off a cliff.
Exactly. And that's a real risk, especially in those hot new industries where everyone's getting excited. Even if a company looks cheap compared to its peers, it could still be overpriced.
Like comparing apples and oranges, but you're not even sure the apples are any good to begin with.
That's a good way to put it. Be careful about relying too much on relative valuation, especially when there's a lot of hype going around.
Okay, so relative valuation, helpful but handle with care. What are some specific things to watch out for? What are the pitfalls?
One of the biggest challenges is finding truly comparable companies. With established industries, it's usually easier. Similar business models, financials, growth prospects. But with young, disruptive companies, it's tough to find a true apples-to-apples comparison.
You might end up comparing a company selling books online to one developing VR software. Totally different animal.
Right. And even if they're in the same space, they might be at very different stages. One might be making money, the other still pre-revenue, burning through cash.
Like comparing a teenager to a toddler. Big difference. What about valuation multiples? Those are used a lot in relative valuation, right?
Yeah, things like price to sales, price to earnings ratios, but they can be misleading because they don't capture the whole picture. The nuances of the business, its long-term potential, the risk.
So you could have two companies with similar price to sales ratios, but one might have much better margins, stronger growth, less risk?
Exactly. Relative valuation can be a starting point, but you got to look under the hood and understand what's driving those numbers before you make any decisions.
Okay, so we've laid out some traps to avoid, but relative valuation can be useful. How should our listener use it without getting misled?
Use it as a sanity check on your fundamental analysis, not as a replacement for it.
So if your DCF model is spitting out a valuation that's way different from what the market is saying, maybe you need to go back and rethink some of your assumptions.
Exactly. Maybe you were too optimistic about their growth or underestimated the competition. Relative valuation can help you spot potential blind spots.
So it can actually be a friend, not a foe, if you use it wisely. Any other tips for getting the most out of it?
Try to understand what's driving those multiples. Don't just look at the numbers. Ask yourself, why is company A trading at a higher multiple than company B? What are the specific reasons?
So instead of just saying company A has a higher price to sales ratio, you might dig deeper and find that it's because they have a stronger brand, more loyal customers, or more innovative products.
Exactly. Understand the why,
Right.
and you can make better judgments about whether those differences make sense.
Okay, relative valuation. A useful tool, but use it with caution. Don't rely on it blindly. Do your own homework and understand what's behind those valuations. Good stuff. We covered a lot in this part. Negative earnings, historical data, comparables, and relative valuation. Lots to think about.
It's a lot, but it's all connected.
In the final part of our deep dive, we'll tie all these threads together and leave our listeners with some final thoughts on how to navigate this world of valuing young companies. It's a challenging world, but it can also be very rewarding. All right, welcome back for the final part of our deep dive into valuing young companies. It's been a wild ride. We've tackled those fundamental principles, the unique challenges these younger companies throw at us, and even waded into the waters of relative valuation.
Feels like we've hiked through a financial jungle, armed with our evaluation tools, and a good amount of skepticism, of course.
Love that analogy. So as we come out of that jungle, back to our listeners and their investment decisions, let's recap. What are the big lessons we want everyone to walk away with, the things to keep top of mind?
Well, first off, remember, valuation is still possible for these companies, even if it feels a bit like predicting the future. It's just inherently more uncertain. But we can adapt.
Embrace that uncertainty. That's the name of the game when you're dealing with companies that are shaking things up, disrupting industries. It's not your typical blue chip valuation, that's for sure.
Right. You're making educated guesses about what might happen. Got to be comfortable with that. But it's not just throwing darts at a board. We can make those guesses smarter, build a framework for thinking about value, even when there are a lot of unknowns.
Okay, so embrace the unknown, but don't just give up on logic and analysis altogether. What else? What's another big takeaway?
Focus on that long-term sustainability.
Yeah.
Don't get distracted by the short-term noise, those earnings swings that can happen. Look for companies with a real competitive edge, good management, a clear path to actually making money.
Can they build a business that can last? Can they fight off the competition? Can they adapt as things change? Those are the questions to ask.
Exactly. And as we saw with Amazon, sustainable margins, that's often the most important factor for these companies. Can they make good profits over the long haul? That's what it all boils down to.
Profits matter, even if they're way out in the future. Speaking of future, got to talk about diversification. How does that fit in here?
Essential, especially when there's this much uncertainty. Don't go all in on one single company, no matter how amazing their idea seems. Spread that risk around. Different companies, different industries, even different stages of a company's life cycle.
Don't put all your eggs in one basket, right? Especially when those baskets are still being made. Might have a few holes.
That's a great way to put it. These companies are still figuring things out, so don't get too attached to any one of them. Now, before we wrap up completely, I want to circle back to something we touched on earlier. Modern's Amazon analysis back in '98. He showed that their stock price, which was pretty high, could be justified, but only if certain assumptions about their future came true. Assumptions that were pretty optimistic.
Which raises a really interesting question for our listeners, right? Is investing in these young, high-growth companies just a gamble? How do you balance that potential for huge rewards with the very real risk that things might not pan out?
Yeah, it's a trade-off. The potential upside is huge. You could be getting in early on the next Amazon, the next Google, but a lot of these companies, they won't live up to the hype. That's the risk.
And what I find fascinating is that even with all the tools we've talked about, there's still a gut feeling element to this. You can analyze the numbers, the competition, but you also have to believe in the company's story.
Absolutely. It's about blending that quantitative analysis with your own judgment. Do you believe in the team, their vision, their ability to execute? That matters.
And that's what makes this so challenging and so rewarding, potentially, when you get it right. It's a constant learning process.
It is. You're never done learning in this game.
Well said. We hope this deep dive has given our listeners some valuable insights, some new tools to help them on their journey. Keep exploring, keep learning, and keep asking those tough questions. That's all for today, everyone. Happy investing.